Hello, this is the second part of topic 2 with double entries booking system. So in the last presentation, we already mentioned about some recordings and some events adjustment. So we continue with the adjustment number 2 in the as of December of 31st, 2013, the company has earned 1,500 of the 1,800 of revenue that it have deferred in event number 3. So this transaction decreases the unearned revenue liability account and increases the contracting revenue equity account, and this transaction is classified as a claim exchange transaction. So $1,500 of revenues is calculated by dividing 1,800 payment by 12 months and then multiplying by the 10 months that elapsed between March 1st, the date that the contract began, and December 31st. Here is the illustration of the impact on the T account. So you can see that there's no impact for the asset account. The unearned service revenues decrease for amount of 1,500. So we have a debit. And for the equity, we record the revenue increase 1,500 on debit side. And here's the effect of this transaction on the financial statements model. The first part, we see that this is a claim exchange transaction because the liability and earned revenues decrease, but equities increase for the same amount of 1,500. For the income statement, we have the revenue increase of 5,100. There's a no impact on the cash flow statement because this transaction is not the cash transaction. So now look at the adjustment number 3. As of December of 31st, Golin Consultant has 800 of accrued salary expense that will be paid in 2014. So this transaction decrease in the salaries payable in the salary increases the salaries payable account and decrease the equities by increase the salaries expense account. It is classified as a claim exchange transaction. And as the same here is the illustration of the impact on the T account. So we have liability, salary payable increase, equity decrease because there's an expense of increase for 800. And finally, you can see the effect of this transaction on the financial statement model. We have a salary payable with an increase on the credit, so with credit, and the salary expense decrease, increase. So we have a debit on the salaries expense. So this transaction, you can see that there's two salaries account, but one is a liability, we call it salary payable, and another is related to equity account with the salaries expense. Now we move as the adjustment number 4. As of December of 31st, 2013, the company had used 500 of the 1,200 of insurance coverage that it have paid for the event number 6. So how can we calculate this one? So we can see that as the company have used 500 of the 1,200 of insurance coverage, it means that the assets account prepaid insurance decreased for amount of 500. However, because the company have to spend, so they have to record. This is insurance expense. It means that for this adjustment, it decrease the equity account for the same amount of the what 500. The 500 of the of insurance expense has a use is calculated by dividing the 1,200 payment by 12 months and multiply by 5 months that elapsed between the August 1st and end of December. The date of payment is December 31st. So here is the transaction. This is the illustration on the T account. We have asset account, prepaid insurance decrease 500. So we use the credit to decrease. But for the equities, insurance expense increase for 500. So we have a debit of 500 here. And finally, you can see the illustration of the impact on the company's financial statements model. Right? The asset account prepaid insurance decrease and the equity the expense decrease. So equity decrease. Here, that kind of transaction is called as asset use transaction. Now we move to our another transaction number 5. As of December 31st, 2030, a physical account of supplies on hand revealed that 125 worth of supply was available for future use. So this transaction decrease the supply and assets account and decrease the equity, the supply expense account. This is classified as an asset use transaction. To determine the amount of the expense recognized for the supply use, add together the beginning balance is 0 plus the purchase is 850. So we have a total assets available for you is 850. We subtract the ending of $125 worth for future use. So we have the assets due of supply is 725. So here is the illustration for the impact on the T account. So we have supplies reduce, decrease for the amount of 725 on the credit side. The equity because we increase expense for supply. So we have a supply expense decrease 725. And here now you can see that there is the impact of this transaction on the financial statements model. So we have finished the second part for recording the transaction. Now we move to the first part. In this part, we will learn how to record transaction using the general journal format and show their effect on the financial statement. The accountants initially record data from the source of information document into a journal. Example of source of documents include invoices, time cards, check stub, and deposit ticket. Transactions are recorded in journal. So this is a form of journal before they enter into the ledgers accounts. Journals are therefore called book for original entry. So we can have a special journal, and together all we call is a general journal. The companies may use a general journal as well as several special journals. Special journals are used to record specific type of repetitive transaction. For example, a company may use a special journal to record cash receipts, another to record cash payments, a third to record the purchase on account, and yet to record sales on account. Transactions that do not fit in a special journal are recorded in the general journal. For simplicity, this text uses only a general journal format. Here is an example of an entry in the general journal. There are columns for the date, account title, debit amount, and credit amount. Notice that the debit accounts are always written first, followed by credit accounts. The credit account titles are indented slightly, and we always have one credit or at least one debit, and the sum amount of debit should be equal credit. Here is a summary of the general journal entry for calling broker rate service. After the transaction has been recorded in the journal, the dollar amount of the debit and credit are transferred to ledger accounts. The process of transfer information from journal to ledger is called posting. Take a few minutes and review the information and be sure you are comfortable with it before we proceed. So you see that we have 11 transactions with the cash, and we have a 5 adjustment by end of the period, right? So the first transaction issuing cash and receiving common stock and receiving cash. The second transaction, the companies buy supply on account. The third one, the company receive cash from the service that they perform later. The fourth transaction, the companies performs the service to the client, but the client will pay later. And the fifth transaction, the company bought land and pay cash. The sixth transaction, the companies bought insurance for the 1 year, which started from August. The seventh transaction, the companies pay in cash for the seventh transaction. Here the companies receive cash from the customer for the account receivable in the previous transaction. The number 8, the companies pay in cash for the salary expense. And the 9th transaction, the companies pay in cash the dividend. For the 11th transaction, the company recorded all the operating expenses that they have a responsibility to settle in the next month. And we have a 5 transaction about adjustment, right? So they record all of the interest receivable revenue from the interest that they will use this. Adjustment number 2, they receive the money from the client for they will record the one part of they perform the service revenue, and they record some salaries payable, they record the adjustment of insurance expense, and finally they adjust the supply expense. The transaction presented in this chapter illustrates the relationship summarized in the panel A of this exhibit. Panel B illustrates the translation in the T account form, so we can see that there is an asset. All the transaction may be decreased or liability, equity, common stock, revenue, expenses, and dividend we call this account, and maybe the increase or decrease will be on the debit and credit. When the asset increase should be always on the debit side, and all of the liability and equity account increase should be on debit. So we always have the asset equal the company. We have asset equal liability plus the owner equity plus the in the equity we have a common stock, the dividend, revenue, and expense. Here is a summary of the lectures account after recording the transaction for Colin brokerage services. So we can see that normally we use to report the assets on one side, the liability on one side, and stockholder equity on one side. So for stockholder equity, we have a common stock, we have a return earning, and we have a dividend. For service revenue, we will have other revenue, other expense. So now we move to the learning objective number 4. We will learn how to prepare a trial balance and explain how it is used to prepare financial statements. In order to test whether the sum of the debit equal credit in the general lectures, the accountant regularly prepare an internal accounting schedule known as a trial balance. A trial balance lists every lecture account and is a balance. Debit balance are listed in one column and credit balances are listed in an adjacent column. The columns are total and the total are compared. So here is the trial balance of Colin brokerage services after all adjusting entry have been made. So we call this adjusted trial balance. So in supplement with detail from the cash and common stock lecture accounts, the adjusted trial balance provides the information to prepare the financial statement for Colin brokerage services. So here is the income statement for 2013. So we have a company name, the income statement for the year ended December. We have a revenue, we have a total revenue from two kinds, service revenue, interest revenue, and expense, and we have a net income. And here is now the statement of changes in the stockholders' equity. At the beginning, the company had a being common stock of 4,000 and the issues more 25,000. So the ending common stock should be the beginning common stock plus the common stock issue of 29,000. The second part of the statement of changes in stockholder equity is about the return earnings. The beginning return earnings is 1,000. The company plus the net income of 4,585. They pay the dividend, so we have a total return earning at the ending of period should be the sum of the beginning plus the net income minus the dividend of 4,785, and the total stock equity should be the sum of the ending common stock and ending return earning of 33,785. And here is the balance sheet of the company. So for the balance sheet of company, this is snapshot of the company. So you can see the asset equal should be the cash account, accounts receivable, accrued interest receivable, prepaid insurance, supplies, and land. So the company have a total asset of 36,785, and we have a total liability and the stockholder equity at the same amount. For the assessment of the cash flow, you can see that there is a cash flow from operating activity, the cash flow from investing activities, the cash flow from financing activity. So here, if you look at the 13,400 account receivable collection plus 1,800 unearned service revenue collection. So we have amount is 15,200. And now we look at the nearly the last one. We use the return some of the financial ratio to calculate the companies how they can use their asset, right? So the first ratio is a return on assets ratio. This ratio evaluating performance requires considering the size of investment base used to produce income. The return on asset ratio is calculated as the net income divided by total assets. This ratio measures the relationship between the level of income and the size of investment. A larger ratio means the company did a better job of managing its assets. The second ratio is the debt to assets ratio. Borrowing money is a risky business. The debt to asset ratio helps evaluate the level of debt risk. It is calculated as a total debt divided by total assets. A smaller ratio indicates that there is a less debt risk for the company. Return on equity ratio. The owners are interested in this ratio because these ratios determine their return on their investment in the company. The return on equity is calculated as a net income divided by stockholders' equity. A larger ratio indicates that the owners have a higher return on their investment. So now we have a look at the who are the stockholder and creditor and what are the different. Stockholders like a lot of debt if the company can take advantages of positive financial leverage. The creditors prefer less debt and more equity because equity represents a buffer of protection. So this exhibit shows the debt to assets, return on assets, and return on equity for 6 real world companies in the 2 different industries. Let's take a few minutes and review this information. The data are drawn from the company's 2010 report. Annual report notice that Aflac the return on asset ratio was 2.3% and Aetna's return on assets was 4.7%. Nature's ratio seems good. Banks sometimes pay more than 2.3 interest on deposit in savings accounts. The return on equity ratios, however, show a different picture. Aflac was 21.2% and Aetna was 17.9%, much better than bank pay deposits. Exhibits shows that while ExxonMobil the return on asset ratio was more than 4 times higher than Aflac, 10.1% versus 2.3%. Its return on equity ratio about 20%, about almost the same 20% and 21.2%. How did this happen? Compare the debt to the assets ratio and finance 89% of its debt for assets. With debt compared to Exxon is 50%. Financial leverage is the biggest factor causing this result, but it is not only the factors that affect this ratio. Why doesn't every company use the financial leverage to the maximum? There is a downside. If the economy turns down, the financial leverage has a negative impact on the return on equity. You may want to take a few minutes to review this ratio for more comparison. So thank you for your kind attention. This chapter explains how to record transactions using the double entry accounting. And see you in the next video. Thank you very much and bye for now.